Have you ever looked at your Social Security deposit and wondered, what if this number is wrong? Not because you made a mistake, not because you forgot to file something, but because somewhere inside a system built on decades of records, paperwork, data entries, and calculations, an error slipped through and nobody ever told you. If you were born before 1955, what I'm about to share could be one of the most important financial discoveries you make this year. And before you assume this does not apply to you, consider this. Thousands of retirees spent years believing their benefits were accurate, only to learn later that they had been receiving less than they were actually entitled to receive. In some cases, the difference was hundreds of dollars every month. Over the course of retirement, that can add up to tens of thousands of dollars. The most surprising part is not that mistakes happen. The surprising part is that most people never find out. The Social Security Administration processes millions of records and benefit payments. The system is massive. It handles information stretching back decades. While many records are accurate, errors can and do occur. When they do, there is usually no phone call, no letter highlighted in red, and no government employee knocking on your door to warn you that your benefit may be lower than it should be. The system calculates a number. That number becomes your monthly check. Most people assume it must be correct. After all, it comes from the government. But what if it isn't? Stay with me because today we are going to uncover why benefit mistakes happen, how they affect retirees born before 1955, and the exact steps you can take to determine whether your own Social Security record deserves a closer look. And make sure you stay until the end because there is one step that many retirees never take. Ironically, it is the step that can make the biggest difference. Before we get into the details, let me tell you a story that perfectly illustrates this problem. A retired mechanic named Harold had spent most of his life working long hours. He was not the type of person who questioned paperwork. For nearly a decade after retirement, his Social Security payment arrived every month like clockwork. He accepted it without a second thought. Why wouldn't he? The money showed up on time. The amount seemed reasonable. Everything appeared normal. One afternoon, his daughter stopped by to visit. She worked in accounting and was used to reviewing financial records. During a conversation about retirement income, she suggested taking a quick look at Harold's Social Security earnings history online. Harold agreed. What happened next took less than 5 minutes. As they reviewed the record, they noticed something strange. Several years during the middle of his working career showed no earnings at all. Zero. But Harold knew he had worked during those years. In fact, he remembered them clearly because he had been working overtime and supporting his growing family. The record said one thing. Reality said another. After digging through old boxes stored in a closet, Harold found employment records and tax documents proving those missing years existed. A correction request was submitted. The records were reviewed. Eventually, the missing earnings were added. The result? His monthly benefit increased significantly, and he received additional money for amounts that should have been paid earlier. What makes this story remarkable is not that it happened. It is how often similar situations happen. Many retirees never check their earnings records. They assume everything was recorded correctly decades ago. Unfortunately, assumptions can become expensive. To understand why, you first need to understand how Social Security benefits are calculated. Every retirement benefit begins with your earnings history. Throughout your working life, employers report wages to the government. Those earnings are recorded and eventually used to determine your retirement benefit. The calculation relies heavily on your highest earning years. Those earnings are adjusted and processed through a formula that determines the foundation of your monthly benefit. That means your benefit is only as accurate as the earnings record used to calculate it. Think about that for a moment. Many people worked for 30, 40, or even 50 years before retirement. Their records stretch across multiple decades. Different employers, changing reporting systems, paper files, electronic databases, and countless opportunities for mistakes. If even one important year is missing or reported incorrectly, the final calculation may not fully reflect what you earned. And when that happens, the impact doesn't disappear after 1 month. It follows you every month. year after year. For some retirees, the difference may seem small at first, maybe $20, maybe $50. But over 10, 15, or 20 years of retirement, those amounts compound into serious money. That is why reviewing your earnings history matters far more than most people realize. There is another issue that affects many retirees born before 1955, and it involves a date that changed the financial future of millions of Americans. If you were born between 1943 and 1954, your full retirement age is 66, not 65, not 67, exactly 66. This age matters because it represents the point at which you qualify for your full retirement benefit. However, Social Security allows individuals to begin claiming benefits earlier. Millions of Americans chose to start collecting benefits at age 62. For many people, that decision made sense at the time. Health concerns, layoffs, financial pressure, or uncertainty about the future often influence the choice. The problem is that many retirees never fully understood the long-term effect. Claiming early does not simply reduce benefits temporarily. The reduction is generally permanent. That means someone who claims several years before full retirement age may receive a smaller monthly benefit for the rest of their life. Imagine expecting a benefit worth $2,000 per month at full retirement age, but receiving significantly less because benefits began early, month after month, year after year. The cumulative difference can be substantial. One retiree described learning this years after filing. She believed she had simply started receiving benefits when she became eligible. Only later did she fully understand how early filing affected her lifetime payments. Her frustration was not about making the decision. Her frustration was about not understanding the decision. And that distinction matters. Financial decisions are easier to accept when people fully understand the consequences beforehand. Unfortunately, many retirees look back and wish someone had explained the numbers more clearly. Now, let me be absolutely clear about something. If you claimed benefits early, this is not about regret. You cannot change the past. What matters is identifying issues that can still be corrected today, because even retirees who claimed at exactly the right age may still have inaccurate benefit calculations if their earnings records contain mistakes. That is where opportunities may still exist. The first step is simple. Create or log in to your My Social Security account. Inside that account is a detailed earnings history showing what was reported under your Social Security number throughout your working life. Most people glance at it once and move on. Don't do that. Study it carefully. Look year by year. Ask yourself whether the numbers make sense. Do you see any years showing zero earnings when you know you worked? Do you see years that appear dramatically lower than expected? Do you notice gaps that don't match your employment history? These details matter because every number contributes to the final benefit calculation. And if the underlying record is wrong, the benefit based on that record may also be wrong. Many retirees are shocked when they discover discrepancies they never noticed before. The reason is simple. Nobody told them to look. Most people assume their earnings history was automatically recorded correctly. Most of the time it was. Sometimes it wasn't. And the only way to know the difference is to verify it yourself. Once you identify a possible issue, the second step involves gathering documentation. Old tax returns, W-2 forms, pay stubs, employment records, anything that helps establish what you actually earned during the years in question. You do not need a perfectly organized archive stretching back 40 years. Start with whatever documentation you can find. Many successful corrections begin with only a handful of records. The important thing is establishing evidence that supports the correction request. What happens after that is where things become especially important, because many retirees stop after finding the error and never take the final actions required to have their records reviewed and corrected. That single mistake may be the difference between discovering a problem and actually fixing it. If there is one lesson you should take away from everything we have discussed so far, it is this. Finding a mistake is only the beginning. The real difference between retirees who recover money and retirees who continue losing it often comes down to what they do after discovering a problem. Many people review their earnings history, notice something that looks unusual, and then put it aside. They tell themselves they will deal with it later. Days become weeks, weeks become months. Eventually, life gets busy, and the issue is forgotten. Meanwhile, the same potentially inaccurate benefit continues arriving month after month. That is why taking action matters. Once you identify a year that appears incorrect, gather every piece of supporting documentation you can find. Tax returns, W-2 forms, payroll records, employer statements, or any other records showing what you earned can help establish your case. Do not worry if you do not have a complete file cabinet of documents. Many retirees are surprised by how much information they can still locate through old records, former employers, tax preparers, or archived financial documents. The goal is simple. You are creating a paper trail that helps verify your earnings history. After gathering your documentation, you can contact the Social Security Administration and begin the process of reviewing the record. Depending on the circumstances, additional forms and supporting evidence may be required. The important thing is to start the conversation rather than assuming the issue will resolve itself. Many retirees never reach this stage because they believe correcting old records is impossible. That belief is not always true. While older records can present challenges, corrections do happen. The key is having documentation that supports the information you are trying to verify. Think about Harold again. For years, he had no idea anything was wrong. The missing earnings were sitting quietly in his record, while his benefit calculation continued using incomplete information. Had he never looked, nothing would have changed. The system would have continued exactly as it was. His benefit would have remained lower. The additional money would never have arrived. That is why awareness matters. Now let's talk about another area that often causes confusion among retirees born before 1955. Delayed retirement credits. Most people understand the concept of claiming early. Fewer people fully understand the rewards associated with waiting longer. For individuals whose full retirement age was 66, delaying benefits beyond that age could increase future payments. These delayed retirement credits were designed to reward people who postponed collecting benefits. In simple terms, waiting longer often resulted in larger monthly checks. The increase could continue accumulating until age 70. For some retirees, that decision produced significantly larger benefits over the course of retirement. But here's the question very few people ask. Were those credits applied correctly? Most assume the answer is yes, and in many cases it is. However, errors can occur whenever calculations involve complex records, multiple filing dates, or manual processing. That means retirees who delayed benefits should occasionally verify that the increase they expected is reflected in the benefit they actually receive. Imagine waiting several years specifically to increase your monthly payment, only to discover that something was overlooked during processing. The possibility may seem unlikely, but it is exactly the kind of issue that makes reviewing your records worthwhile. A few minutes spent examining your benefit information could reveal discrepancies that might otherwise go unnoticed indefinitely. This becomes even more important when survivor benefits enter the picture. Widows and widowers often assume their benefits were calculated correctly because they followed all required procedures. They filed the appropriate paperwork, provided necessary documents, and waited for approval. Unfortunately, there have been situations where calculation errors affected surviving spouses, despite them doing everything correctly. Think about that for a moment. The individual followed the rules. The paperwork was submitted, the claim was approved, yet the final number was still wrong. That reality highlights an important truth about large systems. Mistakes do not always happen because someone failed to act. Sometimes they happen because systems are operated by people, and people are not perfect. The Social Security Administration serves millions of Americans. Employees handle enormous workloads involving retirement benefits, disability claims, survivor benefits, earnings records, and countless other responsibilities. Most employees genuinely want to help. Most claims are processed correctly, But even a very small error rate can affect thousands of people when millions of records are involved. That is why blind trust is not a financial strategy. Verification is. When you review your earnings history, you are not accusing anyone of wrongdoing. You are simply verifying that the information used to calculate your retirement income is accurate. And considering how important that income is, verification makes perfect sense. After all, most people review bank statements. They check credit card bills, they verify tax returns, they examine investment accounts. Yet many retirees never examine the single document that helps determine one of their largest sources of retirement income. That is an extraordinary oversight when you think about it. Your Social Security benefit may represent hundreds of thousands of dollars over the course of retirement. Wouldn't it make sense to verify the calculation behind it? Another reason this topic deserves attention is because retirement today often lasts much longer than previous generations expected. Many retirees spend 20, 25, or even 30 years collecting benefits. Small monthly differences become major financial differences over periods that long. An extra $50 per month may not sound life-changing, but over decades it adds up. An extra $100 per month adds up even faster. And if an error affects a larger amount, the long-term impact can become significant. That is why taking a close look at your records is not about chasing pennies. It is about protecting income that you earned through decades of work. You spent years paying into the system. You earned those benefits. You deserve confidence that the calculation reflects your actual work history. The good news is that reviewing your records does not require advanced financial expertise. You do not need to be an accountant. You do not need to understand every detail of the benefit formula. You simply need to compare your earnings history against what you know about your working life. If something looks unusual, investigate it. If something appears inaccurate, gather evidence. If questions remain unanswered, contact the appropriate office and seek clarification. That approach alone places you ahead of countless retirees who never check at all. And that brings us back to the central message of today's discussion. The greatest risk is not necessarily an error. The greatest risk is never knowing an error exists. Because once a mistake is identified, there may be options available. Before a mistake is identified, there is nothing to correct. So if you were born before 1955, do yourself a favor. Set aside a little time. Log into your My Social Security account. Review your earnings history carefully. Look at every year. Take your time. Do not assume everything is accurate simply because the record exists. Verify it. Because one missing year, one incorrect figure, or one overlooked calculation could affect your retirement income far more than you realize. And if you know someone else collecting Social Security benefits, share this information with them as well. A spouse, a sibling, a friend, a neighbor, someone you care about. Many retirees have never reviewed their earnings history even once. A simple conversation could encourage them to take a look and potentially uncover something important. Retirement is challenging enough without unknowingly leaving money behind. You worked hard for your benefits. You earned them through decades of effort, sacrifice, and contribution. The least you can do is make sure the numbers are working as hard for you as you worked for them. Thank you for spending this time with us today. If you found this information helpful, remember to subscribe, turn on notifications, and stay informed about the changes, updates, and strategies that could affect your retirement income. This is exactly why we created this channel, to help everyday Americans better understand the benefits they earned and the opportunities they may not know exist. Social Secure USA